In the public equity markets, everyone is there to make a profit. You're competing against every analyst and a hedge fund. In bonds and in currencies, they're non-economic actors. You have the Fed, who's not trying to make money. You have people just trying to do currency transactions.
You have big, dumb institutions that are forced to buy bonds.
Exactly.
Yeah, you have people just trying to trade. So let's talk a bit about those markets. I obviously was in macro as well with Peter and Clarion and whatnot, and we had some good years there. It's very interesting right now. We have the long-term bond, going up. I think almost 5% now, I believe, which is unprecedented for a very long time. A lot of people speculating China has been selling / not buying as many things in general with their troubles and also their antipathy towards us these days. And it's actually quite scary. Like our debt payments are having to go way, way up with these higher interest rates. It's I think it's $1 trillion now, but it gets to $2 trillion pretty quickly over the next few years if we don't fix it. And it seems like there's some danger of a spiral out of control where these these rates can go a lot higher. Now that said, the dollar's gotten surprisingly a lot stronger more recently. Maybe it's like is it the strongest of a bunch of bad options, or what's going on here?
Yeah, I think that's what's going on. And so at the broad picture level, it does look pretty bad for yields to go up from here, with a huge amount of fiscal issuance happening and fiscal spending that's not really backed by increase in revenue on that side. So it's going to be an expansion of the deficit. Combine that with pretty bad conditions for demand, where I think this is part of the dollar strength. If I can earn 5-6% on the short end, why would I buy 10-year bonds right now?
JP Morgan's paying me 6% right now.
Exactly.
For risk free. I was gonna build a bunch of buildings near East Austin, where I was gonna try to make an investment there, and the paper return when we mapped it out was about 3.8% yield. Money sitting in the bank makes 6% yield. This is what the Fed's doing. They're slowing down the economy and making it so people like me don't have the incentive to build because it's a waste of money.
Exactly. And I think that also speaks to the dollar strength, where if I'm sitting in Europe, Japan, other places in the developed world, I'm getting, what is, at least in terms of getting dollars back, risk-free payments of that amount. It's hard to beat that really anywhere in the world at that level of risk right now. Now, the other half of this, and we have an expression in macro, in the end, they always print money. So what's going to happen if we keep running up the debt like this? Eventually, you're going to have to print to solve that, and that will be inflationary.
Who is going to buy all this debt? There's going to be a lot more. We're $33 trillion of debt right now, I believe, something like that. The deficit, which is the amount we're losing per year, is it a couple trillion now? Is what I understand?
A couple, and probably going up from there.
Probably going up. It's something like our spending is it's back of the envelope 6 something, and our revenue is 4 or something. Yep. So it's like about 2. But then of the 6 something spending, over $1 trillion of that's debt, and that's that part of it's gonna double probably. So you can't even cut that. You have to only go up. Entitlements can't really be cut very easily, I guess, especially not right now in DC.
Yeah.
So I mean, where does this go? Do we just get into an emerging market like debt spiral, and interest rates go way up, and there's massive inflation, they print lots of money, and gold goes up? I mean, this is like the silly gold bug argument we've been hearing for 20 years. Is it finally going to happen, or what's going on here?
Yeah. So this is a prototypical long-term debt cycle. We talk about these a lot at Bridgewater. There's a short-term cycle, usually lasts 3, 5, 7 years, and there's a long-term cycle, which lasts much longer. As at the beginning of the cycle, debt levels are low, and so it's easy to add debt. Interest rates can climb, and you can still want to add debt.
So what's that longer-term cycle? What are the years you're talking about now?
It takes about 30 to 40 years.
So kind of from the early 1980s, we had very high rates.
And now we've been declining, and now we're at the bottom.
The 2020 was like the bottom, basically almost 0% for a long time. I've observed for 10
yield,
years.
But we're still dealing with basically the hangover effects of that. And so the government replaced private spending in 2020. That's in large part why the economy kept growing despite the contraction in consumer spending with COVID. Government gets spending. We're now getting to a place where, as you correctly mentioned, that debt service becomes a huge part of the deficit. And the Fed can either raise rates and increase the government's own spending on that each year, or cut rates and risk running inflation, which will drive that up even further. And so it's pretty lose-lose. Ways of getting out of it would be a significant restructuring of how we spend, but as you noted, seems unlikely.
So we need either political willpower to restructure how we spend, or crisis.
Because
you can see, it feels like we're on this path, and the path keeps getting narrower and narrower and narrower, and we've slipped off towards the inflation side, and then we're climbing back on, but then we're going to slip off the other side.
Yeah, I'm not a golfer, but I usually describe it as putting on a ridge, which I hear is hard.
Right.
You're trying to walk the Goldilocks path, and speaking of American optimism, I think that's the only way you can describe a really positive path out of this, which I think will need budget cuts.
Well, there's other ways you could do it too. AI could just solve everything, Jake. We could just pray to the AI gods and then put our heads in the sand. This is apparently what a lot of my tech friends are doing.
But unless AI spends money, it's not going to improve the deficit.
You never know.
You never know. It could.
There's some pretty.
It could already be spending
some
money.
pretty clever agents out there.
Yeah.
So, but I mean, AI aside, you either need to restructure spending completely, which actually I don't think it's that hard substantively.
Yeah.
I can make a plan for how we're going to only spend $3 trillion
And
or
deliver
$6
the same
trillion
quality
and deliver
services
same quality services by having competence and accountability and firing a lot of useless bureaucrats. But assuming that we don't put dictator Lonsdale in charge here, because that's not how a country works, and that these guys can't get their act together in D.C., then there's going to be a crisis instead. What does a crisis look like?
So my guess is, and this is just a guess, and he who lives by the crystal ball will eat glass, but that it looks more like a slow bleed out than one sort of imminent moment. Of course, there will be shocks, but I think what it looks like is for a protracted period, 12, 15 plus years, rates are higher than they would otherwise be because there's this big gap in demand for bonds and exogenous demand. So similar to your example of that housing development, if because the government is spending too much and not matching that to income streams for years and years, we have just elevated bond levels exogenously, that's going to really hurt the real economy.
Yep.
It might not happen all at once. It might, but I think it looks more like it's just a higher cost of capital.
Almost 5% already on the 10-year and long bond is already probably impacting things very negatively.
Oh yeah, I mean, no one has an incentive to refinance. It is very hard if you got a mortgage anytime in the last 15 years to think about moving right now, and housing activity is a major driver of economic growth.
I guess some people would tell me, well, Joe, these are normal rates if you go back in time, like 20, 30, 50, 60 years. These are normal rates now. But I guess the question, do we blow through them and go to higher? But you don't think there's any.
And I
you
don't
think there's near-term crises, but you think this is a longer term. This is a 10-year thing.
I think this is a longer-term thing. There will be bumps in the road for sure, and we'll probably have more bank issues that will be symptoms of the disease, but I think the disease is much more long-term in nature.